Welcome back to the channel. Today, the focus is on a big question many investors are asking. Is everything really expensive in the stock market right now? The answer might surprise you. Let's start with the big picture. The market has been putting up strong numbers this year. If you've simply been invested in broad index funds like QQQ, DIA, SPY, or VTI, chances are you're sitting on gains of 10% or more. That's coming after 2 consecutive years where markets already delivered over 20% each year. Pretty impressive. But the real question is, can it last? One of the big concerns right now is valuation. The S&P 500 is trading at a high forward PE multiple, which makes it look pricey. But when that is compared with the so-called risk-free rate, like the 10-year U.S. Treasury yield, things get interesting. As of late September 2025, the earnings yield of the S&P 500 is around 4.2%. The 10-year Treasury, almost the exact same, 4.18%. Now, compare that to the dot-com bubble of 1999. Back then, the S&P 500 was trading at a PE ratio in the low 30s, giving an earnings yield around 3.3%. But the 10-year Treasury was paying 6 to 6.5%. Investors actually had a solid alternative back then, and when the bubble popped, money flowed out fast. Today, the situation is very different. We're not cheap, but we're definitely not in 1999 bubble territory either. So, where does value still exist? That's where Joel Greenblatt's magic formula investing system comes in. Straight from his book, The Little Book That Beats the Market. The approach is simple. Take the largest companies, rank them by quality and cheapness, and invest in the top 30 to 50 names equally. Quality is measured by return on invested capital, or similar metrics like return on total capital. Cheapness is measured by earnings yield, which is just the inverse of the PE ratio. Put them together and you have a powerful screening method that cuts through the noise. Using this method on companies with a market cap of at least $16 billion, a list of the top value opportunities right now emerges. Let's go through the top 5 deals. First one, Altria Group, ticker symbol MO. A classic dividend stock that continues to screen as one of the cheapest large cap names. The yield is down from its near 10% peak in 2024, but the stock still offers strong cash flow and attractive valuations. Second, Lululemon. The yoga apparel giant has stumbled recently. Inflation, tariffs, and slowing growth have hit the sector hard. But for investors who believe premium apparel isn't going anywhere, this could be a solid entry point. The Hewlett-Packard is paying a dividend north of 4%. HP is still generating plenty of free cash flow. With personal computers and printers remaining essential, this one continues to look undervalued. One of my picks is Adobe. A household name in digital creativity, Adobe faces competition from AI tools that can generate and edit images for free. But its sticky subscription model, brand strength, and ongoing growth in both revenue and earnings make it a compelling value opportunity. The last one, Expeditors International of Washington. A logistics company that's often overlooked, especially with competition from FedEx, UPS, and even Amazon. While recent growth has slowed after the COVID surge, EXPD's long-term fundamentals remain stronger than many realize. Beyond these 5, healthcare and pharma also stand out as deeply undervalued sectors. Political pressure has weighed heavily on the industry, but history shows that these cycles don't last forever. Patient investors collecting dividends today may be setting themselves up for significant rewards in the future. Of course, value investing isn't always easy. In a roaring bull market, chasing low valuation names can mean underperforming in the short term. But for those who believe in mean reversion, the idea that markets eventually balance out, this strategy has historically paid off. So, while the market overall may look expensive, there are still plenty of opportunities hiding in plain sight. Combining valuations with return on capital can uncover strong businesses trading at fair prices, the kind of names that can deliver long-term outperformance. That wraps up today's breakdown. Which of these names do you think offers the best value right now? Drop a comment below and let's start a discussion.